Hi YouTube, I wanted to give you an update on my portfolio that I call the $1 Million IRA. I call it that because I wanted to reach $1 million in value by way of both contributions and performance. And what I've done since the last video is 3 trades. I exited Volkswagen and I trimmed my position in 2 of my stocks that have been big winners for me. This video is mostly about that agonizing decision as to when you should realize or sell some of your gains. With respect to my exiting of Volkswagen, the reason I did that is that in December 2018, only a few months ago, I doubled down on equities. I really went almost all cash with this IRA portfolio. In the sell-off, I bought several of the companies on my watch list. So far, that was a good decision. However, it expanded the number of stocks in the portfolio to 33, including Volkswagen. And I've always said it's a very important caveat. I think it's an important feature of mine that I'm a part-time investor because it means I only have a few hours per week. That's a very important limiter, and I cannot in a few hours a week analyze or stay on top of these stocks in the way that I would like to. 33, it's very much too many, maybe 5 too many at least. And so I've decided I need to reduce the number of that. And Volkswagen falls at the bottom. And actually, not because I like it the least. There are maybe 1 or 2 stocks here I like less. The reason is that it takes up a disproportionate amount of my attention because it's a more complex holding than some of my others. Volkswagen's a German company. This is an ADR. It's not the only ticker on Volkswagen. It's not a large cap, so the coverage is light or maybe non-existent, so I don't get analyst help on that. Also, we have a different ownership structure than we tend to have in the U.S. It's not as purely shareholder. The labor unions have an important say. There was just an important vote in Tennessee. And of course, historically, we have the overhang of Dieselgate and those liabilities that arguably have helped keep this stock depressed at current levels at which it really contains almost free embedded options on some of their business units or divisions. And then maybe going forward, maybe most importantly, if we're looking at this Volkswagen as a stock, is the competitive question of, in an overall automobile market that is generally shrinking, how are they doing with market share, in particular electric vehicles and autonomous vehicles? So there's a lot of good argument there for this stock, I think. On balance, I like it more than I dislike it, but it's just complicated, and I don't have the time anymore, and I want to reduce the number, and so I'm letting it go. And sort of cognitively, I already feel better about that. And so then I have the 32 stocks listed here that remain in the portfolio, still with a goal. I still want to get this down to 25, let's say. And I use this tool here, Stock Rover, and which keeps track of my sort of high-level view on them. In green, these are my buys. These are the ones that I like and no plans to sell, and I hold them with some confidence or conviction. Then I've got a yellow here that I'm holding with less conviction, that I'm just waiting as new information comes in. And then finally, I've got this orange tier of evaluation that I divide into subdivide. My evaluation means that, okay, I'm monitoring this for a possible sale, but it's either for a good reason or a bad reason, right? These 4 I'm evaluating because my price appreciation has been better than I expected. So these are generally strong double-digit winners for me. And so I just want to look at them in terms of the valuation discipline. And that includes, you can see, Alteryx and QTWO. And so I did decide to trim, not exit these 2, because the run-up has been much more than I expected. And now, they're just expensive. And then I do have 4 that are under evaluation because since I purchased them, new information, new news. Let me say information, not news. New information has come in that causes me to want to be to be monitored these for possible sale, but so far haven't done that. As I struggle with the decision about what to do with my two winners, in this case, Alteryx and Q2, I kept thinking of a quote I've read from Peter Lynch: selling your winners and holding your losers is like cutting the flowers and watering the weeds. And I like that because I worry that that's what I'm doing. I don't know, but I worry that that's what I'm doing because, well, in terms of watering the weeds, Cloudera, my biggest loser, is a weed that I watered. I had two opportunities, I covered this in a previous video, to sell that when I had red flags. Other people saw it, I did not. I watered the weed on Cloudera in a big way. In a previous video, I mentioned that the only saving grace there was Alteryx, which I'm going to talk about next, AYX. At the time that I bought Cloudera, I bought Alteryx as well because I purchased a data science cluster that included Hortonworks, which Cloudera subsequently merged with. So my data science cluster included the 3 and is reduced to 2. And the only thing that's interesting about that is my painful loss in Cloudera, which is unrealized loss of $27,000. Pains me to say, biggest loss ever. On paper though, unrealized. Actually has been almost exactly offset by the gain in what is my biggest winner so far. Alteryx, never saw this coming, also about plus $27,000. So while Cloudera is so ugly for me, my data science cluster is about break even owing to my Alteryx. Very interesting. But you see I'm trimming the flower here on an Alteryx, so I worry about that. And I just don't know. To help me, I went back to my CFA syllabus, level 2, level 3, to see what it says about the cell discipline. And I will say that the CFA syllabus is fantastic in depth. However, it has not a lot to say about cell discipline. There's a lot more about bi-discipline. And I find that so interesting. What I could collect is the following sort of 5 theoretical reasons for why we might sell. Of course, if we reach or exceed our price target. Also the information target. I think that's interesting because I didn't have a name for it, but that's what I'm doing with Instructure, which is currently my highest conviction holding. I've added to it several times. They make a learning management system because they're in the e-learning business. And so in the education business, which is primarily college, but also K-12, Instructure is now shifting this year from number 2 to the number 1 LMS in the education market. They're basically displacing Blackboard, which frankly is pretty much of a disaster of a company, sorry to say. So I've seen this coming for a long time. And so they're going to be number 1 if they're not already as we speak. Number 1 in the education market for LMS. Very sticky market. Net retention rates are great. Not super sexy growth. It's not 40%. It's more like 10 to 15, but they've got a whole international market. So long way of saying that over in the education market, I have what I think is in relative terms, a relatively safe holding, or let's just say moderately risky at most. And then what I have in terms of the information target on the corporate side is we have their bridge product where they have not broken out any of the quantitative metrics yet. But the company, the new CEO is very focused on that, and we just don't know. So I think of this as the sort of free option. This will be the catalyst. I am confident. We don't know what kind of success Instructure will see with the bridge product in the corporate market, but what we do know is that's a huge market. And if they break it out quantitatively and start to show some success metrics, I feel like that'll be hitting the information target, and this company will actually jump to another level just in terms of showing up on the radar as a company that can compete in corporate. So I don't know if that'll happen. I'm just waiting to see. But that's an information target for me. Third reason, fundamentals, either deterioration or the fundamentals have altered the valuation of the company. Fourth would be up from or down from a cost. And this simply refers to compared to your cost basis, have you gained a lot or lost a loss? This could be this could be the trigger to sell. And in a way, in terms of Alteryx and Q2, I guess I'm employing the up from, because I'm up from my cost basis, and now it's causing me to reevaluate. But I also revisit the valuation. And the fifth reason I got from the CFA is substitution, and this reminds me of Porter's five strategy framework, or Porter's strategy framework. There, the idea is since you purchased, if a new company has come in with a new product that can easily substitute for yours, then that's a serious competitive threat, and that should trigger a reevaluation, possibly a sell. So that makes a lot of sense. Competitive threat, maybe this is equivalent to disruption. Well, okay, so in terms of the two trims, Alteryx, which is, as I've mentioned, I never saw the phenomenal performance. I just underestimated this company. When I bought it, I thought it looked good, but I bought it as part of a data science cluster. And each quarter that they turn in the fundamental performance, it's been phenomenal. And usually when you look at the quarter, even a great quarter, a company will look good on certain metrics, and then almost always there's some weakness. But in Alteryx case, last two quarters, when I've looked at it, I gotta say it's been strong across the board. And so just so rare to say that. And so I think it might be it's fair to ask me if I should even consider selling a company that continues to turn in such phenomenal performance. But the valuations become rich, so I am going to trim. But they're the leader now in self-service data analytics. They sell, it's an expensive product. You can see Alteryx Designer, $5,195 user per year. Their target market is really what they call the citizen data scientists. So it's all those analysts, including could be staff on finance, that are not really maybe professional coders, and they may be, but they can use these visual tools to perform a lot of the data analysis, like including some of the machine learning. So you think about that, that would be a huge market, right? There's a lot of, there's more citizen data scientists than there are professional developers. There are a lot of people who want to use the the tools of data science and want to use the benefits of machine learning that don't nearly have the skills to write the code to do that. So Alteryx steps in with these visual solutions, which is just a phenomenal market to be sure. And then in the last investor presentation, they shared an update in terms of their long-term targets, including, look at this, gross margin. Gross margins have been 81% and trending up, and a sustained long-term target on their gross margin, 90 to 92% long-term target, pretty phenomenal. If you think I'm making a mistake to trim any at all, I wouldn't blame you at all. I'm just trying to develop my own sell discipline. That's all. I can find no weaknesses in this company at the moment. And they provided forward guidance of, you can see 44 to 50%. So pretty much 50%, and they've been growing at least 50%. And the stock chart has reflected this, certainly since I bought it. And then more recently, the external event that impacted the run-up this week and sort of actually reinforced my decision to take a little bit off the table, as they say, is Salesforce. That's ticker CRM. I'm sure you've heard of that company. They're based in San Francisco. They purchased Tableau software in their biggest acquisition ever. I think it was $15.7 billion. Tableau, well, broadly speaking, is in the Alteryx space, although Tableau's expertise is data visualization. And from what I've read, that's sort of if Alteryx has a product portfolio weakness, it might be on the visualization side. However, in general, they're considered being a similar category. And so naturally, articles published this week about who Salesforce just bought Tableau for almost $16 billion. Who's going to be next? And Alteryx is always on that list. Stock gets a bump. Personally, I never buy a stock. I never incorporate acquisition rumors or an acquisition theory into my purchase. That's my style. I at most would consider it an embedded free option, right? But I would never want to pay for that because I just consider that too much to be too much of a random event. It usually involves a narrative that I can't even begin to assign a probability to. Whoops, I lost that. So, and finally, in terms of the Alteryx and some of its fundamentals, this is a share from my Stockopedia, one of my favorite tools. It shows you how they're not a huge company in terms of revenues, trailing 12 months, not even 300 million, but we do see that long-term CAGR on the revenue growth is 60%, consistent really with that forward guidance of 50%. And you can see in reported EPS, they've even crossed over into positive territory. We have a company that's $6 billion market cap. If you're not used to it, I highly recommend in your analysis always looking at the market cap. I could do a whole video on that. Won't spend that now, but I do think that's a really important parameter. You really want to know, am I looking at a micro cap, a small cap, a mid cap, a large cap? A lot goes into that. I believe that's a very important factor in the analysis. So Alteryx, I said it's gotten expensive. The price sales is 24 times, and I think you've got to call that expensive. The enterprise value to EBITDA is 152. Now, I'm still working this out, what to do about this, because I'll look at these value metrics to be sure, but it's very easy. If you want to defend either a buy or sell, I will say about the price sales, it's just easy to argue either way. There was a good article this last week defending the Alteryx valuation and actually setting a very aggressive price target. How could you do that? The defense of a higher price target turns out to be ridiculously easy to do. How do you do it? Well, if we have a price to sales of 24 at the moment, and if we have the benefit of a projected 50% revenue growth, and now here I'm going to defend a purchase of the stock, even though I wouldn't buy it. If we have a 24 price to sales, and so I'm going to multiply by 1 in the numerator, and then what I'm going to put in the denominator is 1.5 because they basically, I'm rounding up to their guidance of 50%. And the article I read used a 50% revenue growth projection, right? So if we take 24, all we need to do is multiply by 1 divided by 1.5, and we get 16 as a viable forward price sales, but I go forward to the next year using a growth rate of 15%. And if I want to go 2 years forward, I multiply by that same 1 divided by 1.5, or I could have just taken the 24 and multiplied by 1 divided by 1.5 squared. Then I get, what do I get? 10.7. So 16, that's my I'm going to do forward 1 is 16 right here. And if I want to go forward 2 years, I get 10.7. And you get the picture now. If I want to do something like, I mean, we never quote these, but a forward price sales forward 3 years, I multiply by 1 over 1.5. I get to 7.11, I guess. And so now that's actually a viable price sales. So I can say to you, well, listen, if you're willing to buy at a 3-year forward price sales of 7.11, this stock looks about fairly valued. And in such a way, it's just a question of how far forward we go until we can set a price target. You can see it's not hard to find a price target that's twice where we currently are. What's the key to that? Well, obviously the key to that is the 50% constant growth rate. Obviously won't go on forever, but how long that could go on. So, you know, you can absolutely accept that narrative. And in fact, a lot of these stocks have been fantastic. I mean, one of the best categories of stocks to buy, if you look back, if you're able to back test, is stocks that look cheap, that were small, growing fast. Small, growing fast. They looked expensive on our normal metrics, but they were growing so fast that it only took a couple years for them to become cheap. And really, basically, the stock price just follows their growth rate. So it's a fantastic, I mean, a lot of my stocks are really in this high growth or growth at a reasonable category, growth at a reasonable price. They are in this sort of category, so you can make the defense. But my ultimate point here is just how difficult it is to set a price target and defend a valuation, because you are growing so rapidly that forward multiples almost become putty in your hands depending on the assumption you want to use. So I don't have a definitive answer to that. What I just wanted to share is that I bought, it was only in November of 2017. I entered with my typical $10,000 entry. I didn't add, which in retrospect, you know, I should have added on the strength, because I was looking at the quarter, should have added on the strength. I should have watered that flower. But even without that, I had 259%. Price was $98.20 earlier in the week, and I decided to trim 46%. And so that, because that leaves me with a balance of 200 shares, and I still have a $20,000 position. So you can see, I am bullish on the company. I like the fact I have 2 times my initial value. And so this is just the right balance for me in my evolution. And I'll just be interested to see, if I'm completely proved wrong. If they continue to do what they've done, then I shouldn't have sold anything, right? But I'm just figuring out my discipline, frankly. I'm just going to keep, it's just practice. Selling, I'm just taking action as part of my practice and part of my own learning. And then very briefly on Q2, because I've written a whole article on them on Seeking Alpha. I called it, this was in March, I called it Banking on Q2 Holdings, Fairly Valued but Enviable FinTech Holding. That included my valuation chart. This is from my article in Seeking Alpha, but powered by Y Charts, where I included the Q2 holdings and some other commentary. You can see where on enterprise value to forward revenues, 9.52, we're starting to hit the upper bound of the peer group that I've defined, my peer group for Q2 holdings. My map is here because they're based in Austin, my favorite city, so I'll always have a geographical bias in favor. Any company in Austin, to me, automatically gets a premium. So similarly, I've seen the price appreciation. Now, the fundamental growths going forward, the fundamental narrative is not as strong as it is in the Alteryx case. They don't have, for example, the total addressable market, although they did just buy an acquisition. In my article, I mentioned that. They've expanded their total addressable market, I think, with the last move, according to them, from 5 to 8 billion. And so we shall see a little bit on their financials here, not GAAP profitable. And what I've done there is again, about the same time that I bought Alteryx, I had a roughly $10,000 position. You can see a 66% gain. And what I've done there is I sold 35%, 80 shares. So my balance was, you can see, roughly back to that $10,000 position that sort of makes me comfortable in my diversification. 10,000 never puts me out too much on a limb with any one stock. And so you can say I realized the gain, and I'm back to I'm back to where I was, pocketing the gain. And so that's sort of where I'd like to be in Q2. I'm still have a position in a company I like, although for this company, again, if I didn't own it and I were analyzing it freshly, just like I said in my article, I don't think I would buy. It would be on my watch list, but it'd be a little too rich to buy, and I'd be waiting to see, if something caused it to become affordable, a market sell-off like happened in December, and I was able to buy some companies. So that's my update for my portfolio, and I hope you have a good weekend. Thank you.